All right. So we are looking at what we call IFRS 16, what we call basically leases. Your teacher today is called Dr. Joshua Aura. Dr. Joshua Aura teaches where? At RCM College, right? Physical classes at Standbank House, first floor. If you go to Standbank House, next to National Archives, first floor, you go to get RCM Standbank House, first floor. And then, of course, I teach RCM Online College, virtual classes. I like virtual classes most because, I mean, we are controlling a very big number over there. We are able to help so many people who are spread across the entire East Africa, all right? So physical classes are there. They are very nice. Of course, there are those students who prefer physical. Welcome them there. But of course, everybody now, all right? Regardless of where you are based, you need these online classes. We are bringing classes to your bedrooms, to your living rooms, so you don't have any excuse for not studying. So today, I would want us to look at, just 1 minute. So I will be doing 2 past paper questions. One past paper question will be an FRA question, and another question will come from the AFRA on leases. So the the FRA, Financial Reporting and Analysis question that I would want us to look at is August 2022, question number 4A. So August 2022, question number 4A is what I want to look at today, is what I want us to look at today. But before that, it will be very important for you to tell you guys what leases are. Leasing is a very big market all over this world. Not many people will be able to put up big structures in town for their businesses. Building a big structure, like for example, what we have at Standbank House, is not for everybody. They are very expensive. They're running into billions. But you see, most people have these great business ideas, but they don't have money to build such kind of buildings. So in this case here, what do they do at the end of the day? They will be able to go to these landlords and then they lease properties. They lease spaces here, little spaces. Some space in this case here being leased for salons. Some spaces here being leased by colleges like that. So anytime we talk about lease, we shall be hearing languages like landlord, tenant, or basically we shall be hearing things like lessor and what here, lessee. So lessor basically will be the landlord depending on the nature of the property, and the lessee will be the tenant, Now, ladies and gentlemen, please listen and listen to me very well. Whenever we talk of lessor and lessee, one person must be ceding what we call right of use. So we have here right of use, right of using. So remember, this property belongs to some landlord. But this landlord, of course, he has big money. He's been able to put big properties like a mall. But he doesn't have, for example, the expertise, or he may not have a business idea that will be able to occupy the entire mall. So what do? They relinquish their right of usage. Yes, the building is ours as the landlord, but because we have some spare spaces there, we would rather in this case here give someone else this space to use it. So in IFRS 16, we shall be hearing a lot this concept of what here, right of use, right, let me write this in full, right of use. Ladies and gentlemen, remember it is the person who has the right of use who will be depreciating the asset. So once the lessor, the landlord has given control of his asset to a third party called a tenant or a lessee, it is the lessee who will be having control of that asset. So it is this lessee who will be required to do what? To depreciate. So whenever it comes to depreciation, we shall be looking at, of course, in this case here, the lessor, the landlord, has relinquished the right of use to the lessee. So the lessee, like if it's RCM Standbank, that space that is there, Now we are the ones in this case who are supposed to be doing what? To be depreciating, because now we are the ones who have the right of using this asset. Why are we depreciating this asset and yet the building legally does not belong to us? Ladies and gentlemen, remember the definition of the word asset. What is an asset? So an asset, basically, if you remember the definitions here, is any resource that you expect in the future to give you economic benefits. You, as the person who is using it at the moment, you'll be able to derive economic benefits from this space. So then if I'm going to get economic benefits like the students who are studying at RCM Standbank, fat flow, those students, of course, they are paying fees to RCM College. So we are getting, in this case, economic benefits. And therefore, we are the ones then who are controlling the space. The students who go there do not even know who the landlord is. They can't pay fees to the landlord. This fees is now being paid to us as the lessee. So therefore, we have an asset there for the 5 years. Remember, most leases are long-term. For the 5 years, 3 months, we shall be having the asset as ours. I mean, even the landlord cannot just walk in. If the landlord in this case here comes in and yet we are paying our rents very well, then that will be trespass. So long as we have right of use, I'm reiterating here, I'm repeating here, so long as we have the right of use, then automatically we, the lessees, we RCM College, will be the ones in this case, will be doing what here? Who will be depreciating? Will be the ones who will be depreciating. So at this stage, of course, as I continue, I'm so sure there are those students who are following me through my YouTube, through Facebook. I expect you guys to do the honorable thing. You must follow your mwalimu. Remember, we are ninjas in the game. You must promote this ninja here. You follow mwalimu, you subscribe there. You need to be giving me thumbs up. If possible, comment down there. Ask questions down there so that the Google engine will, of course, prioritize. When people are looking for leases in the search engines, they should be able to see this Dr. Joshua Aura's channel coming up. So please don't let me down there, you ninjas. Subscribe. And for the students who are following me on Zoom, of course, you simply go to YouTube and look for Joshua Aura. You'll be able to get my various channels there. Even on LinkedIn. LinkedIn is very, very good. LinkedIn, search for Joshua Aura. LinkedIn, search for RCM College. Follow our college like that. So, ladies and gentlemen, let me go back to leases. So basically, under lease, according to IFRS 16 definition lease, a lease happens when a lessor gives away the right of using an asset, to a lessee for a specified period and a consideration being paid. So for us to talk over a lease contract, ladies and gentlemen, being there, we must be very specific of the assets. There must be an asset that has been leased to us for us to talk over contract. So there is a specific asset leased to us. It is Standbank House, first floor. You'll be able to get RCM space there. It's our space. It can't be substituted. If this person can come and tell you now move from this room to this other room, the landlord that is, then I don't have power of controlling this. That can't be a lease contract. That can't be a lease contract. So there must be a specified asset. There must be a specified period. There must be consideration. Hey, you ninja, if you're given someone's a house, you are there as a tenant, you have a contract written down, and then you say you're not going to pay rent, then there is no lease contract there. There must be consideration to be paid. There must be consideration to be paid. So I would want to know whether up to here we are together, and I can see we are 30 online. 30 on Zoom. I should be able to buy these guys small lunch. 30 is a very good number. But are we connecting? Are we connecting? Are we able to understand each other here? Are we connecting? Are we able to understand each other here? Are we connecting? They're not talking. They're not talking. All right. Thank you very much. So whenever we talk of lease, according to IFRS 17, there will be a lessor or a lessor versus a lessee. So the lessor is handing over the right of usage to the lessee of a specific asset for a specified consideration, for a specified duration. That's how you put it. Right of usage. And then don't forget that given that this right of usage of the asset has been handed over to the lessee is the one who will be doing what here now? depreciating. Depreciation now will be carried over by the lessee. The lessor will not be depreciating. Now, ladies and gentlemen, then there is something that you must be able to appreciate from the word go. There is something that you must be able to appreciate from the word go. There is something you must be able to appreciate from the word go. What is this thing that I would want you guys to appreciate from the word go? So the lessor has given you the right of usage of his asset. So this guy, for 5 years, he expects you to pay for that right to use this asset. He expects you to pay like fully at once. So he calculates all the rent is 20 million. So he expects you to pay fully at once. But I mean, if I had 20 million here, honestly, in lump sum, I would rather build my own water, my own building. I would rather buy my own property. It's because I don't have that amount of money, which makes me run to this landlord. All right. Now that I don't have that money, I'll be paying this guy slowly, month after month or quarter after quarter, depending on the lease contract. So then that means that given that I'm not able to pay this guy all the amount at once, I will be liable to him. And that is why the very first thing you need to do whenever you see a question on lease, you are supposed straight away to calculate what we call present value of lease liability. You're supposed to come and calculate what we call present value of lease liability. Very important. PV of lease liability. Present value of lease liability. Present value of lease liability. Now, ladies and gentlemen, I would want us to read this question right away, which I happen to be having here. For those of you, of course, who have got the RCM's revision kits, I always like students working with this RCM's revision kit. For AFRS students, they can simply go to page number 8. Page number 8, and they'll be able to get that particular question there. Page number 8. They'll be able to get that particular question there. But of course, for the advanced students who are here with me, because they don't have this book, and of course, I can't tell them to buy this book, it's low below them. I would want them to look at this. It's a very important question. Borrowed from ACCA. This one here. Question 3. I'm calling it question 3. I think I should be able to attach it here in Zoom. For you guys to be able to do what here, to basically understand it very well. So this question is your past paper question. It's an FRA question. Of course, FRA and AFR, there's a very thin line between them. So we are reading this together. On 1st January 2019, Breakwood Limited entered into a contract to lease an item of plant and equipment from a supplier for a 3-year period. So remember, the right of using this asset is just 3 years. The term of the lease was that Breakwood Limited was to pay 500,000 each year, with payments commencing on 31st December 2019, end of the year. Initial direct cost incurred on the lease amount to 30,000 and were paid for by Breakwood Limited. The plant and the equipment had a remaining economic useful life for 5 years. That economic useful life for 5 years is hot air. We're not going to use it anywhere. Ourselves shall not use it anywhere, because for us, as the lessees, we only recognize the time we shall stay with this asset under the lease period, which is 3 years. So this economic life of the entire asset is hot air. They would want to use this to intimidate us. But of course, we can't be intimidated. We know the subject very well. At the inception of the lease contract did not contain any purchase option for the lessee. Breakwood Limited can borrow at a rate of 10% a year. So this borrowing rate, this is the rate of interest, it is the cost of capital. It is the rate of interest, it is the cost of capital. Required, analyze the accounting treatment of all the above lease transactions from the inception and for the 3-year period of the lease, of the lease contract. So, ladies and gentlemen, then what are we going to do? This is a very simple question totally. It is lessor it is lessee. It's a question about what here? Lessee. And specifically here, if you read the question again very well, analyze the accounting treatment of the above transaction from the inception and for the 3-year period of the lease contract. So basically, here we are doing lessee accounting, the tenant accounting, financial reporting from the tenant's aspect, And this is what we shall do, ladies and gentlemen. When I get this kind of a question, I will ask myself, how much are we paying in form of rent? So in form of rent, what we are paying here, it's 500,000. So, and this 500,000 is not payable only once. This 500,000 will be paid every year for 3 years. So that there are future cash flows. And if there are future cash flows, then the very first thing that I need to do is to discount those cash flows to be able to get to what we call present value of lease liability. Present value of lease, because they are futuristic, you see. They are futuristic, ladies and gentlemen, here. We are told, line number two, that the terms of the lease were that Breakwood Limited was to pay 500,000 each year, with the payments commencing on 31st December 2019, and it's not lost on us that the lease period is 3 years. So you're going to pay, I'm going to cut those 3 zeros. We talk about what year? We talk about 500. So this is the payment schedule, and this is what I'll do. So the first thing that I'm doing here is to calculate the present value of lease liability. So we have here the lease period, not the economic lifetime of the machinery. The lease period is year 1, year 2, year 3. And we are going to have our cash flows here as the tenants. We are paying rent, you know. We are paying rent. So we are paying 500. We are paying 500 every year. In shillings, thousands, remember. All right. So then the very first thing that I need to do is to come and discount these cash flows. Let's discount them. To discount them, of course, we have got 2 types of cash flows, if you remember. We have got 2 types of cash flows for discounting purposes. We have uniform cash flows and we have irregular. Uniform and then we have irregular. Uniform are the ones we call annuities. And if you look at this very well, these are what here? These are uniform, isn't it? These are uniform cash flows. We agree. Please comment there. There is a comment section. Even the guys who are following me on YouTube, wherever, I expect you guys to be commenting. I want to see my videos having so many comments. Are you able to see that these are annuities? Because of 500? They are annuities. Thank you so much. They are annuities. However, if you go to an exam and you get confused a little bit, actually the very best way is for you to assume that these are not annuities. You treat them as if they are independent cash flows. So in this case, if I'm treating them as if they're independent cash flows, I will come and discount these using what we call PV. So I'll do this using the 2 methods. I assume that they are independent. I assume that they are irregular, and then I discount them. Using the lump sums PV. Remember, irregular cash flows, we shall always discount irregular cash flows using PV. If I were you, I would write that in my mother tongue somewhere, that we discount irregular cash flows using PV. We normally discount the regular ones. The uniform ones like this one, we normally call them annuities. Those ones, we normally discount them using PV for present value, interest factor over an annuity. Present value, interest factor over an annuity. Present value, interest factor of an annuity. Present value, interest factor of an annuity. So I'm repeating, ladies and gentlemen, anytime you see cash flows, it will be very important for you to see their pattern. When you see that these are non-repetitive cash flows, non-repeating cash flows, we shall always discount them. The ones we are calling irregular, so irregular, you shall discount irregular using PV. And you shall discount now the uniform ones. You shall discount the uniform ones. The ones we are calling annuities. The ones you are calling annuities, you shall discount them using PVFA. PVFA, present value interest factor of an annuity. And the PVF is the one we use this formula. 1 plus R raised to negative what here? 1 plus R raised to negative N. 1 plus R raised to negative N. I'll be able to answer you, Selimith, right now. I'll be answering you in a few minutes. Which question are we doing? So what are we saying here? If cash flows are irregular, they are fluctuating. If they are fluctuating, then you use PVF to discount them. And the PVF is the one whose formula is written here. It is 1 plus R raised to negative N. So this is the formula I'm using here. 1 plus R raised to negative N like that. I'll use the other formula later. So here, of course, it's not lost on me that these values are really annuity, they're regular. But I'm saying let's treat them as if they're independent. So then if they're independent, the cost of capital has been given in this question. The cost of capital has been given in this question as 10%. As 10%. So Shalmith, here we are, we can take a screenshot of this question. Here we are, we can take a screenshot of this question. So in this case here, we are told here that we can borrow at 10%. R is the required return. The borrowing rate is 10% here. The borrowing rate is 10%. Borrowing rate is 10%. We can borrow at 10%. So there's the cost of capital. All right. So in this case here, we have here 1 plus R raised to negative what here? Raised to negative N. So then this will be 1 plus 0.1, the 10%, raised to minus 1 because of year 1. This will be 1 plus 0.1 raised to negative 2 because of year 2. Then this will be 1 plus 0.1 raised to negative 3, raised to negative 3. So is there somebody who can please ensure that all of us are using our calculators well? And ensure that we are able to see where raise is. Where raise is. Raise in this case here will be, for example, a button written like that, raised, or x raised to y. So ensure that you're using, this is 1.1 raised to negative 1. Can somebody give me the first value? Can somebody give me the first value here? Can somebody give me the first value here? I have Leonida giving me 0.9091. But how comes it's only one student? Even students who are doing this in YouTube or wherever, following this through YouTube or wherever, you need to be giving me those answers there. That's how you really become active, proactive. Proactiveness is about you're using it, you're typing there, you're typing, you're doing this and this. That is very important. The other ninjas, are they able to get that 0.9091 really? The other ninjas, are they able to get that 0.9091? Year 2 Esther has given me 0.264. Year 2, we have 0.8264. How I wish it was all students who are confirming these figures for us to be able to move together very well. For us to be able to move together very well, I wish it was all students who are confirming these figures. 0.8264, 0.7513. So we have here 0.7513. These figures are annuities, but why are you treating them as if they're irregular? It's one of the ways, where you treat those figures as if they're independent, as if they're fluctuating, and then you handle them using PVF. And then now you can come and create the last column here for discounted cash flows. Please, you must write that in full. If you're doing this thing for the very first time, you write there, discounted cash flows. So discounted cash flows, you'll take this cash flow, the rent amount you're going to pay here, you take these figures, you multiply them with a PVF. You multiply them with a PVF here. You multiply them with a PVF. Multiply them with a PVF. So we have here 500 times 0.9091. 500 times 0.9091. Please give me a figure, please. Don't forget, ladies and gentlemen, that we're giving you this great session from RCM College. We would want to invite all of you to join us. This is our number, 0719-525,000. 0719-525,000. 0719-525,000 is our number. So we have here the first student is giving me the first answer as 454.55. 454.55. I don't think I'll be able to continue doing so many questions for you guys because I'm not really seeing that we are really connecting, because you guys can't even give me answers. So you guys then would want, like, once we finish this question, we end the class there, which will be very unfortunate because I have really a big program, but I can only continue if I'm seeing like we are connecting, you know. So the last answer is 375, 413.2. 413.2. I would expect you guys to give me answers or ask questions. I love students who ask questions. If you're able to ask questions, I'll be very happy. 413.2, 413.2, 413.2. That's for year 2. For year 3, 375.6. I wish you guys would round off to like 2 decimal places. 2 decimal places will be quite accurate for us. The more the decimal places, the more accurate we are. Then we have here 375.66. 375.66, and then come and give me now, given that these are discounted cash flows, please come and give me here. Please come and give me here the total. Give me the total here. Please give me the total there. Please give me the total here. Oh, we shall overcome, Paul. We shall overcome. We shall overcome. These are those impromptu sessions that I normally just sit down and think, where can't I teach this? Because I also don't like, whenever I see any free time, I always like occupying myself, making myself busy, but I hope Paul will be able to follow regardless. 1243.41. 1243.41. So this is very important. So this is the total present value of our lease liability. So this is what we call PV of lease liability. PV of lease liability. So the tenant, from the word go, he knows that he has this liability. So present value of lease liability. Present value of lease liability. Which another student would have done it this way. Ladies and gentlemen, please allow Mwalimu to rub this. And after I rub this, I'll be able to show you method number 2 for getting this present value lease liability. For getting this present value lease liability. Now listen, remember we have got 2 types of cash flows. We have 2 types of cash flows. We have 2 types of cash flows. We have what we call PV, which is 1 plus R raised to negative n, and then we have what we call PVFA. PVFA is 1 minus this simple formula. PVFA is 1 minus this simple formula. The simple formula being 1 plus R raised to negative n. And then you come and divide everything by R. You come and divide everything by R. You come and divide everything by R. Given that 500 was repetitive, if it's repetitive, it's uniform. The proper approach should be for us to use PVFA. And how do we use this PVFA? Already now we have the formula. So then if that is the case, remember our cost of capital is 10%. And our lease period is 3 years. Leave out the 5 years from this analysis. Remember, they gave us the time lifespan of the plant, which was 5. That one is irrelevant. Leave it away. So in this particular case, ladies and gentlemen, we have our PVFA 10% against our 3 years of leasing the asset. So then let us do our abracadabra and substitute this here. So it will be 1 minus 1 plus 0.1 raised to, here we consolidate everything because it's 1 of now. It's an annuity repetitive. So we'll talk of the entire 3 year. And then everything to be divided by R, which is 0.1. So here you have really to be very nice with your calculator. So with your calculator, you'll go down there, say 1 minus open brackets, 1 minus open brackets, 1 plus 0.1. You close brackets, and then you raise to -3, and then you say equals. You raise to -3, and then you say equals. Once you've done that, you come and divide this by R, which is 0.1. And then I would want to see so many students giving me an answer. I would want to see so many guys giving me an answer. I would want to see so many students giving me an answer. I would want to see so many students giving me an answer. The PVFA answer. The PVFA answer. So how are we doing it? We are taking here 1 minus 1.1 raised to -3, equals. And then whatever you do, you divide by 0.1. Whatever you do, you divide by 0.1. We have here Francisca 2.48. I will want 4 decimal places. So remember, for PVIFs and PVFAs, we always prefer four decimal places. We always prefer 4 decimal places. We always prefer 4 decimal places. We always prefer 4 decimal places. 4, not 3, not many, but just 4. Is there somebody who has that answer in 4 decimal places? Anybody would be having that answer in 4 decimal places? 4 decimal places. 4 decimal places. According to Selmith, it is 2.4869. 2.4869. So I also expect when I go to my YouTube channel, this answer, somebody should be posting it there. Always, if you want to learn from videos very well, ensure that you are also posting video or other answers you get in that particular comment section. That's how we connect. It's called interaction. I need to see. And if you're not getting those answers here on YouTube, you simply say that you're not getting, and then I'll be able to see that feedback, and then I'll be able to just come through. All right. So all of us, we are getting this answer. Thank you so much. And therefore, the total present value of lease liability, we shall take the cash flow, just one of it, just 500 times now the PV fund. You don't do like 500, no, just one. You only choose one. So 500 times 2.4869. Please give me an answer here. 500 times 2.4869. Please give me an answer here. Please give me an answer here. So simply take one, because you know they are repetitive, they are regular. So you take only one to represent the others. And then you multiply this with the PV far. 1243.45. 1243.45. Remember, we chopped the 3 zeros, right? We chopped the 3 zeros. Remember, we chopped the 3 zeros. 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 So is this answer very close to the one that we got here using the other method? Is it very close to the one that we got using the other method? Is it very close to the one that we got using the other? Apart from rounding off errors, we expect them to be exactly the same. All right, we expect them to be exactly the same. I have to teach you both, because what will happen is this. The examiner, and he has done this severally, he'll come and tell you 1, 2, 3, he'll give you 500, 500, 600. So he spoils the game here. So if he spoils the game, even if it's just one number, which is not, rallying, just one number. If there is a spoiler, then I must always use PV. In your exam, in most cases, there will be a spoiler. Whenever there is a spoiler in between, then we must always do what here, use PV. So if, for example, 2 numbers are to be the same, and then the third and fourth numbers are different, don't treat this as if they are annuities. Treat them as if they are independent, and then you calculate PV for each one of them. You handle them like that. It's good. There is some learning that has happened there. Ladies and gentlemen, if I'm the one doing this, I know this tenancy thing. Once you'll be able to give me the present value of lease liability, it is someone's loan I have. And if I have someone's loan, then the next thing that I need to come and do is to come, ladies and gentlemen, here and do a loan amortization schedule. We shall do a loan amortization schedule. We do a loan, because you see now these are loan really. Somebody has given me the right of use, and we know the total liability. So from there we do a loan amortization schedule. And this is the easiest thing ever. You get so many accountants who do not know how to amortize loans. This is the easiest thing ever. So then, ladies and gentlemen, what I will do here, I will come here and talk about the year. Remember, it is the lease life. Lease life 1, 2, 3. Lease life is 1, 2, 3. 1, 2, 3, like that. And then, ladies and gentlemen, we have in this case here opening balance. The opening balance, which is lease liability, which is our lease liability. And then, ladies and gentlemen, we have in this case, of course, there must be interest to pay because it's a loan. There must be interest that you shall pay because it's a loan. And then, of course, we have the installments you are paying back. The installments. So these installments are always our cash flows. These are always our cash flows. And then now we have closing balance. Closing balance. We have the closing balance like that. We have the closing balance like that. Very nice. Very nice. Very nice. I love this. Very nice. I love this. I really love this. I really love this. Very nice. Very nice. So, ladies and gentlemen, I would want, once you guys are able to put down the structure, once you put down this structure, I would want you to put thumbs up like this. Put thumbs up like this. Once you put down the structure, please put thumbs up like this for me to continue. I don't want to leave anybody behind. Nobody's being left behind. But again, as you do that, don't forget that we're giving you this free of charge financial reporting, advanced financial reporting session from RCM College. RCM College, you can join and study with us, either virtually. Virtual is very good because you pay 4,000. You pay 4,800 per paper. 4,800 per paper. Very affordable. And we have all CPA papers and all sessions, early morning, day sessions, evening, late evening, weekend only. You can choose. And we have, even BDA. You see, it's CFA, BDA, it is CS, it is CPA. So many. And then, of course, we have our physical classes for the students who believe in Mwalimu being there. For example, if you are with me, of course, you have to take a cup of tea with me. So if you believe working with Mwalimu together, we have our physical classes at Standard Bank House. We have our physical classes at Standard Bank House. So then we have this figure. You guys, please remind Mwalimu this figure. The opening balance was 12 something. I've forgotten this figure. It was 12 something. The opening balance was 12 something. The opening balance was 1243 point something. Give me the decimals. Was it 45.45? Remember, our figures here are in shillings, thousands. Shillings, thousands. So opening balance is 12. Yeah, please give me the whole figure, please. If you don't mind, just give me the whole figure. The one that I wrote here. There is the one that I wrote here. There is the one that I wrote here. 2 decimal places. Let me just go back to 1243.4 something. 0.41, 0.4, 1243.4. Was it 41, 43, 45? What was it? Let's agree, all of us, and work with one figure. Let's agree. Whatever we had up there, I'm so sure because of rounding off errors, we could have had a slightly different figure, slightly, which are allowed by the examiner. Allowed by the examiner. 45. Abracadabra, come and give me the interest. So 10% interest. Remember, interest is normally levied on the opening balance. So you take 10% of the opening balance. So 10% of this opening balance, this will be 124.345. 10% of the opening balance. Installment, do we remember our cash flows? Oh, yes, our cash flows, we used them to get present value. Our cash flows here were 500 year one, put brackets, 500 year two, put brackets, 500 year three, put brackets like that. Those were our balances. Those were our balances. Those balances, but installments, what we are paying as lease rentals. So then I would want somebody here to give me the closing balance. How do we get closing balance? We take opening balance plus the interest minus the cash flow. You take opening plus this minus this 500, you get the closing balance. If you want to get closing balance, if I would have been in your shoes, closing balance will always be opening plus interest minus installment. That's how we get the closing balance. Please give me the first one. Please give me the first one. Give me the first one. Please give me the first one. Kindly give me the first one. And I'm so happy getting Zoom ninjas in class. Getting Zoom ninjas in class, 30 of them. It's not easy. It's not easy. It's not easy. But I believe most of you, because this is a free session, you shall make a decision to join me, to join our financial reporting classes, our advanced financial reporting classes. And this is our number, 0719 525,000. 0719 525,000. I'm waiting for somebody to give me the closing balance there without fearing anybody without fearing anybody, without fearing anybody. How do we get the closing balance? We are taking the opening plus interest earned minus that 500. So we have here 867.795. 867.795. Please use your figures. If your figures are a little bit different because of rounding off errors, make use of your figures. So this closing balance is what comes here as the opening. This is what comes here as the opening balance, 867.795. All right, let it earn interest. It shall earn interest here, 10% of the opening. So 10% of the opening, this will be 86.7795. 10% of opening. 10% of opening will be 86.7795. So go ahead and give me the closing balance. So how do I get the closing balance? How do I get the closing balance? You'll take the opening plus the interest minus this 5, and now you can start rounding off figures. You can start rounding off figures. Don't go more than 4 decimal places. Don't go more than 4 decimal places. You can start rounding off. So please give me the closing balance for year number 2. Give me the closing balance for year number 2. Closing balance for year number 2. Closing balance for year number 2. Abracadabra, abracadabra, abracadabra. How I wish these guys here knew the concept of interactions, where you're able to speak with Mwalimu through the comment section. If you know that secret, because if you don't know that secret, you're taking a backbencher position. Backbenchers normally CP harass them a lot. Backbenchers. One thing you'll allow and get used to if you want to pass this thing round 1, always talk in a class. Talk in class throughout. Talk in class throughout. So we are getting a figure of 454.57. 454.5745. 5745. This is what I bring as the opening. So we have here 454.57545. I mean, 10% of this. 10% of this will be 454. 45.457.5. If we round off to 4 decimal places, whichever. So it will be this plus this interest minus 500. Minus this thing should be able to amortize to 0. It should be able to amortize to 0. Even if you get negative 0.0, don't write those rubbish things here. Show the examiner that you really know what you're doing with the amortization schedule. All right. So you tell the examiner that we have got an exact. You can even cheat him. You can even cheat him because at times you get 5. But this one I think is really quite close. This one should be what here? Should be 0. That one 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 should be 0. Now, ladies and gentlemen, from there, I'll be able to go to the next step. Next step is for you to come and give us the journal entries for the right of use. Journal entries for the right of use. Give us journal entries for the right of use. So in this case here, we shall debit, we shall credit. So of course, we are crediting lease liability. We are crediting lease liability, and the lease liability is 1243.45. 1243.45. 1243.45. Assuming there were no other expenses that were incurred, then this figure is what I would have debited straight away to our asset known as right of use. But in this question, we had some direct cost to enable us to use this asset. Perhaps painting, some legal costs, which of course you have to incur for you to be able to get this asset called right of use. So in this question, we had some expenses. We had some other expenses apart from these tenancy expenses, the landlord, the rent expenses. We are told here that the initial direct cost incurred on the lease amounted to 30,000 and were paid for by the lessee, Breakwood. So you can see in this case here, we paid 30,000. So then what do? We pay those direct costs here. So we paid credit bank. Remember our figures, we are chopping 3 zeros. So that is 30. So you'll be able to add the two of them. These two will enable you to use the asset. So this is 1273. So the right of use is 1273.45. The right of use is 1273.45. The right of use is 1273.45. Because you add the two. I don't know whether up to here we are together. This general entry is very, very important. Up to here, I don't know whether we are together. Are we together? Up to here, are we together? Up to here, are we together? Are we together? Please feel free to ask questions. Remember, I'm the chief ninja here. And I always love questions. I always love being asked here questions. Or if you are together, you simply put your thumbs up like this. So you can go to the next kick. Want to go to the next kick. Want to go to the next kick. Ninjas are about kicking. Ninjas are about kicking. All right. What are we debiting? We are debiting a right of use. So we have a leased asset, which we are calling right of use. It's an asset. It's an asset. It's an asset. I hope you're able to see that. And the right of use, there's no way you'll be able to use this asset if you're not paying the tenancy fee, and if you're not paying this legal cost at the beginning, for example. What do you call the direct costs at the beginning? At the beginning. I hope, Robin, you are well answered. Great. Thank you so much. Now, after you've gotten this right of use, then go ahead and depreciate. So give us depreciation of right of use. Depreciation of ROU. We depreciate the ROU. And remember, this is always straight line depreciation. Straight line. So we'll take this 1273.45. Should I divide this by the economic life of the plant, which is 5? Or should I divide this by the lease life? Should I use lease life of 3? Or should I use economic life of the machine, 5 years? 3. We always use the lease life. So we divide this by 3. We divide this by 3. We divide this by 3. So 1273.45 divided by 3. Divided by 3. Divided by 3. So divided by 3. What are we getting there? What are we getting here? What are we getting here? Can you give me this in 2 decimal places? So depreciation of right of use. Depreciation of right of use. What are we getting here? Depreciation of right of use. Depreciation of right of use divided by 3. These ninjas are tired. I don't know where they get tired that fast, these ninjas. And they're very young. They're very young. Young age-wise, young at heart. So 424.48, 424.48, 424.48. There we are, 424.48, 424.48 like that, 424.48. Now, ladies and gentlemen, once you've been able to give me this figure, then I will be able to show you something very nice. I will be able to show you something very nice. Something very nice. What is this something that is very nice? What is this something that is very nice? Now we can go straight away to extracted. You know, at the end of the day, they wanted us to do accounts. They wanted us to do financial reports. So we have to finish this by giving our examiner extracted income statement and the extracted statement of financial position. Now we are only left with 2 kicks. The giant will go down. So come and give me the extracted P&L. 2 things only. 1, 2, 3. 2 things only. Number 1, it will be the interest expense. Interest expense. So the interest expense, what do we have? The interest expense, we have 124.345. You simply copy this column. Interest expense, 124.345. We have here 86. You can round off to 78. 86.78. And then we have here 45.46. That is interest. Then you bring here depreciation. Depreciation per annum. Depreciation per annum. This is an expense that you bring here. And you guys have given me this depreciation. It is 424.48. It is 424.48. So it's normally uniform. 424.48 is normally uniform, 424.48, like that. That is extracted P&L. That is extracted P&L. Quisa, vitu viwili peke yake. The interest expense and the depreciation. Those are the things that you extract and take to your income statement. Those two things alone. So, ladies and gentlemen, is that okay? Is that okay? Is that okay? Now I'm so happy because I can see now you guys are responding. You're responding. I think my kicks are strong enough. Kicks of a ninja. Kicks of a ninja. Now you guys are responding now. I'm so happy, although I can't see like Queen. Queen, I haven't seen you today. I don't know whether you are avoiding, maybe you're falling from your workplace. Now from there, come and give me the extracted statement of financial what year position. Go ahead and give me the extracted. This is the easiest normally. Extracted statement of financial position. The last kick now. The last kick now. The last kick now. So we have here extracted statement. We have here extracted statement of financial position. Extracted statement of financial position. So we have 1, we have 2, we have 3, like that. And then of course we have here our lease liability. We call it lease liability. So lease liability, you simply take the closing balance. Lease liability, you take our closing balances. Closing balances, these ones here, I round them off 2 decimal places, 867.80. 2 decimal places, 454.57. 2 decimal places, 0. But remember, some of this lease liability will be paid in the future. So we must come and break down this. So we must do what we call a breakdowns. A breakdown, not downs, a breakdown. So breakdown into non-current, breakdown into non-current and the current, what we are extracting to non-current lease liability and to current lease liability. Great, Ninja. Great. Yes, Robinson. Great. All right. So come and break down this. Now, you see, out of this amount that we have here, some of it will be paid next year. Some of it will be paid next year. So whatever is being deferred and paid next year is what we call non-current. And normally to get this non-current is very easy. We normally use what we call the secondary diagonal. You simply pull this here. You simply pull the one to be paid, the amount to be paid next year. You pull this here. So it will be, so non-current here, this will be 454.57. That's the first. And then you pull this here to year 2, 0. Of course, here there's nothing to be pulled. So the difference is what we call current. The difference is what will be paid in the current year. So to get what will be paid the current year, you take this minus this, you give me an answer. This minus this, give me an answer. This minus this, I know it is 454. Don't put lines here. 454.57. This will be, don't also put brackets. You simply do it silently. So this minus this, who can give me this current lease liability? Who can give me this current lease liability? Current lease liability, according to Selmith, it is 413.23. It's 413.23. And the moment you do it like that, you'll be able to get all the marks appertaining to that question. All the marks. You'll be able to get all the marks in that question. You'll be able to get all the marks in that question. You'll be able to get all the marks in that question. All the marks in that question. So are we together now, ladies and gentlemen? Have you guys been able to see some things that you've never seen before? You know, there are students I teach that maybe you've never taught me before, but here, for sure now, these leases, now I understand them much better. Now I understand this lease reporting much better. Is there anybody who is able to see things that they've never seen? They've seen them today here. They've been able to understand them today here, these ninjas. Don't forget, ladies and gentlemen, that this great class, we're giving it to you from RCN College. My name is Dr. Joshua Aura. please, I would want you to promote my work on these social media handles. Go to LinkedIn, search for RCM College. Search for RCM College. Please ensure that you're following there. You're making comments there. That's how you'll be able to pull students, in this case here, to us at RCM, because we're giving a very, very good product, a very good service here. Go to YouTube, just search for Joshua Aura or RCM Online College on YouTube. You'll be able to get us there. All right. You'll be able to get us there. All right. Go to Facebook, RCM Online College. You'll get us there. All right. And most importantly, we really take this opportunity to thank all of you for your referrals. I mean, if there is any college that is growing at quite a high rate, it is RCM College, courtesy of you, my great ninjas here. I can see you really know how to throw marketing kicks outside there to bring students to us. And if you've got those kind of students, of course, outside there who don't know where to go to, RCM is their home. Call us through this number, 0719 525,000, 0719 525,000, or 0793 555 000. 0793 555 000. Pooling and discounting. Thank you so much. We shall support you, Mwalimu. Thank you so much. Much better, much better, much better. Otherwise, we've done more than an hour. I strongly believe that we should be able to stop here until late in the afternoon. That's why I want you to follow me in my social media handles, the ones I've mentioned, because I'll just make an announcement and most of you will not be able to see, right? But I think from 3 p.m., I'll be able to call upon you so they can do one advanced financial reporting question. Otherwise, from this Chief Ninja to yourselves is much love. Bye. Bye and have a good day. Bye. And of course, don't forget to hit that subscription. That is very important to me. That subscription is very important.